Hi, I'm Steve Marsden from UHY Haynes Norton. Thanks for pushing play. Today I want to talk about post-Royal Commission banking. I'm beginning to think that the Australian economy will be a scarier place by the end of the year. I recently worked with a couple who were amazing savers. They both earn around $70,000 and they live in the middle of a major capital city. And over 5 years they have managed to save up $140,000 and put a deposit of about 40 grand on an investment unit in Brisbane off the plan. Now in a few months they get to receive the keys to that investment and finish with the remainder of the purchase price. The problem is, when they signed up to buy the investment property, credit was easy in Australia. That was just under 2 years ago. In the past 12 months, banks have all increased their interest rates, and suddenly they have become scared to lend money to customers, unless of course they already have the money and are already wealthy. They're happy to lend to those. Suddenly lending more than a loan to value ratio of 70% has become problematic for the banking industry, and now they want mortgage insurance, even though these clients that I'm dealing with, for example, have funds in the bank already for a different purpose, and they still can't get a loan that's satisfactory to them from their bank. Now, this was all before the Royal Commission. However, you could see that the banks were preparing for the Royal Commission outcomes. I, for one, feel the Royal Commission was overdue, and I'm glad it happened. We all need to place the spotlight on areas of concern occasionally and get the processes cleaned up. Now, whether the outcomes make sense is another thing. So let me expand on that point. The Honourable Kenneth Hayne suggests that banks tighten up their processes. Now that sounds fairly worthwhile. He also suggests that mortgage brokers charge for their services. But let's think that through. So now the banks aren't going to be paying the brokers. The public will be. Brokers will go out of business, and there's 10,000 of them, by the way, because the public doesn't really want to pay for that service. That's where do we go from here? Well, of course, we go back to the bank. Now, I'm sure that's the outcome that we didn't want. And of course, the mother of all suggestions in this Royal Commission outcome is, instead of making APRA and ASIC, who are the watchdogs of the industry overseeing the banking industry, they want to spend more of our public funds on a new watchdog bureaucracy to oversee the other two watchdogs to make them do their job. Does that make sense to anyone? And more likely, a new government will probably make the banks contribute or pay for the new watchdog. And the banks, of course, will make us pay for the increase in the costs of banking. Doesn't sound a lot of smarts going on there. Overall, banks will double down on tightening of their money lending in the next 12 months. And this will further dry up demand for property and quicken the fall in the markets of Sydney and Melbourne. It is as clear as day. I really hope that the powers that make these decisions take a big glass of common sense and consider more innovative ways to implement the Henry Report than what Mr. Henry proposes in its raw form. For more information on the Royal Commission outcomes, feel free to call our team at UHY Haynes Norton on 4972 1300. Thanks for listening.